about what the first 2 weeks of the quarter were going to look like? David E. did a bunch of work, and he kind of likes the first week. There is now the 3rd through the 13th. So 13th is yesterday. So 3rd, there's the first week. So I'm basically into the first 2 weeks now. So the question ultimately is, does this image look similar to the first week? And so if we, the end of the first week is the 7th. So if we go back, let's change this back to the 7th. You can see, image looks about the same. So the interesting thing about this, like, why would the banks do better? Keep in mind that last quarter, they actually thought we were way over here, which would mean, that we're in full recession, market bottom. Here's the financials, right? The financials do good when the market's strong, right? Full recovery. And the Fed's got to be raising interest rates, right? Because them raising interest rates is going to try and slow things down. So if we were over here, then it would mean that the Fed probably is near done raising their interest rates. And maybe they actually start lowering interest rates because we're in a recession and the market's bottoming. But then this quarter, we get this crazy ass data. You can see the part of the market that does really well in recession and market bottoms is doing horribly. And the part of the market that does really, really well at market tops, full recovery, Fed's got to be raising interest rates. Well, that's where we're kicking ass. And the interesting thing is that was the first week, and you kind of go, well, maybe that's just an anomaly. Those crazy traders, they don't know what the hell they're doing. So let's go and look at the first 2 weeks. Well, it's the same damn message. Interesting industrials, even materials, staples, all of these this has got to be the sweet spot of the market right now. And again, that's sort of talking about market top, full recovery. What does the Fed do in market tops and full recoveries? Interest rates, full recovery, rising rapidly. Now, in that kind of environment, that's actually where these kind of guys are going to do okay. Right? If we were over here and we were heading into this part of the cycle, you want to stay the hell away from things like financials, utilities, real estate, all that kind of stuff. But if we're right here and the Fed's cranking interest rates up, well, that's not too far down the road. So I get the impression that what's happened here is that they sold the market off last quarter, because remember, there's August, right? There's third quarter there. Now we're heading into fourth quarter. I get the impression that, maybe they just overdid this a little bit, that actually the financials should do a little bit better going forward. That's the impression that I got, that this isn't as bad a part of the economic cycle for the financials as they had been pricing them in. Because keep in mind, you can see there is the disaster of the Canadian banks right now. Now, this is all a conversation about where we are in the economic cycle, but what we are missing about this conversation is the absolute disaster that things like the Canadian real estate market are subject to. Now, the interesting thing about these Canadian banks, especially something like TD, when I talk about TD Bank to you guys, do you think about the Canadian mortgage market, or do you think about things like TD Ameritrade? I think that's the name of it, isn't it? Their activity in the U.S. Financial services industry. So in a weird sort of way, these banks, they're slightly insulated from, horrible Canadian real estate disaster that I think is pending. But at the same time, too, they're going to be dragged down by that poor situation. I just get the impression that the economic sort of the sector rotation people, they're kind of telling us that we're not in the absolute disaster part of the cycle. We're actually rip roaring along here. And if anything, we should be expecting higher interest rates from the Fed.